So here we are now at open and closed-end funds. We don't really need to get much into this now, but they are types of management companies. They are the only two types of what are classified as management companies. And we'll discuss that more when we get to the unit on the Investment Company Act of 1940. But first I want to talk about my boat and my warehouse. Got lots of hobbies. One of them is I like actually building boats. I'm building a special kind of boat. What this has is it's 1,000 seats or cabins or whatever. It's $1,000 each. And I then go and buy stuff, stocks and bonds, things like that. And everyone's going to own 1/1000th of the boat's value. So if the boat goes up in value, your share goes up, your seat value goes up, your cabin value goes up. If it goes down, cabin value goes down. And if someone wants to get on my boat, they're going to come to me. The problem is I've already sold 1,000 seats. I don't have any more seats. You've got to find someone who's selling. If you are trying to get off my boat, you want to sell your seat and get your money back and get your money out. It's gone up. You want to actually get the money and go spend it. Well, I'm actually afraid of the water. I don't want seats. I just build these boats. But once I ship them off to sea, understand this is not a real boat. We don't have to worry about it capsizing. The only change in value on this boat is what the market value does as it goes up and down. The other option I have is I have a warehouse. I have a warehouse full of stuff. And it's a magic warehouse. It can get bigger and smaller. Now you come to me and you can give me money. Any amount of money you want. And I'm going to figure out what percentage ownership, how many shares of ownership, depending on the value you give me, that it's going to be. But I'm going to give you the exact amount there. And when you want to get your money out, you just have to come back to me. I will take your shares and I will destroy them and give you your money. I'll sell stuff off. I'll go grab the cash, whatever. I'll give you your money back. All you got to do is come to me. My warehouse is great. You can give me any amount of money when you want to buy in. Whenever you want to sell, I'll give it to you. Now understand, and we're going to get into this a little bit more, I've got to be able to make money, right? If I'm buying if I'm buying back from you at the same basic price I'm selling to you, the actual value of what it is, the true mathematical value, I'm not really be able to make any money. And so there's basically three ways. We will discuss this further. Don't worry about this now. But there's three sort of ways where you're going to come and give me money and I'm going to figure out what percentage ownership it is and then give you a little bit less than that. And I'm going to take that difference as my profit, my ability to make money. It'll be upfront. You'll know. That's one option. The other option is when you want to take your money back, when you want to get your money back, maybe I'll take some of it then. So when you sell it, I'll take some of what you redeem it for. That's another option. Or potentially, we could figure out an arrangement where you're simply paying me an annual fee to be able to store your money, for me to invest your money and work it in my warehouse. One of those three ways, but I've got to be able to make money. So we got to understand that. But the catch is I'm the only one with the keys. If you want to get out of my warehouse, you got to come to me. If you want to get into my warehouse, you got to come to me. If your neighbor really likes my boat and wants to buy your seat and you guys can negotiate a price between the two of you, there's nothing stopping you from selling them your seat. My warehouse, though, you can't sell your share in my warehouse. This is how I explain, and the story that I like to use to explain the basic difference between a closed-end fund and an open-end fund. There are more differences. We're going to come to them shortly. But before that, I want to get to the topic of how these things are sort of sold, the price system, how these are quoted. Because there's two numbers that are going to be given. I always use the example. If I bought this can at 7-Eleven or some store, there are going to be two prices. If I go and I look at the books of the store, and those two prices are going to be, I don't know, 25 cents and 75 cents. One of them is the price the store is buying it at. The other is the price the store is selling it at. Same idea here. The bid is the wholesale price. This is the lower price in almost every case. We're going to get to when it might not be. In the real world, it's always the lower price. In test world, it may not be if they want you to think about a closed-end fund. But almost always it's going to be the lower price. It is the highest price that a buyer, that a broker-dealer, that a firm is willing to pay to give you a retail investor. This is what you, a retail investor, sell at. If I could sell cans of soda to 7-Eleven at 25 cents a can, they'd buy them from me. If it was 24 cents, they would definitely buy them from me. Problem is, we all understand that I can't do that, at least not making any kind of money. I'd be able to do it until my money ran out. The other price is the ask price. This is the retail price. Typically found in most cases with an upfront sales charge. You have the actual value, the NAV, the bid, taking all the shares, all of the ownership in my warehouse, or all of the seats on my boat, and taking the entire value of the boat or the warehouse and dividing it by those numbers of seats or those numbers of shares. That is the actual value of what that is. I'm then going to charge a little bit of a sales charge, my commission, my fee, how I make my money. And we're going to arrive at the POP, the public offering price. We have the net asset value plus a sales charge is going to equal the public offering price or the ask price. This is important. NAV and POP are very important in mutual funds, which is what most of us are going to be dealing with. Bid and ask are much more used in like the exchange markets, which Series 6 reps can't deal with. So the POP and NAV are should become much more intuitive. The public offering price or the net asset value. One of them is the actual physical value. If everything was liquidated, what the cash of that ownership would be worth. The other is what the public is offered to purchase at. The public offering price is what the public can buy at. That's going to be higher. That's going to include some profit for the firm. It's the larger number in the quote. We buy at ask. And if you ever get confused, this is something my partner told me. I've loved it ever since I heard it. It saved me all kinds of time. If you ever get confused, just remember to ask POP before you buy. Ask and POP are the same, and you do it when you buy. These are a table that's going to give a couple more of the facts. I don't give everything. That example that I just used isn't everything about open and closed in the boat and warehouse. It's just most of them. The closed-end fund is an initial offering a fixed number of shares, my 1,000 seats. But the open-end is an unlimited primary offering. We're going to discuss primary offering definitely in more detail. But what that basically means is that it must always be sold with a prospectus. In the grand scheme, it's always sold with a prospectus, and I'm the only one that buys and sells them. I, the issuer, am the only one that buys and sells them. The closed-end funds, you can buy and sell only full shares. You cannot buy half a seat on my boat. You could buy 1 seat, or 3 seats, or 10, or 20, or 50, however many you want. But you can't buy 4.5 seats. One of the things that I always tell all of my students, everyone who's been through my classes, I always talk about this. Go and find a rep in your office and ask them the precise number of shares that one of their clients has in a mutual fund. You don't want to know anything about the client. You don't want to know their name. You don't want to know their gender, their age. No information about the client. No information about the mutual fund. You don't want to know what they're invested in. All you want to know is the exact, precise number of shares. Stress precise. Especially if they're a student of mine, a former student of mine, they're going to understand what you're asking. If they're not, they might be confused until they realize where you're trying to go, because they're going to tell you that they have a client that has something like 176.834226 shares, 4, 5, or 6 decimal places, because you never buy whole shares of open-end funds, of mutual funds. Open-end funds are mutual funds. They're sold by the decimal. You want to give $100, I'm going to take it. I don't care if I'm happen to be selling ownership at $97 or $92.50. You give me $100, I'll give you a precise amount. The closed-end fund only trade on the secondary market. Think about a whole line of people on the shore who are always willing to buy and sell the seats on my boat. But the price at which they're going to be doing it is supply and demand. How many are available and how much people want them. Just because the seat might be worth $1,200 doesn't mean anyone's willing to pay you that for it. And that is why you could, in a closed-end fund, have POP being less than NAV. You can't have that in an open-end fund. The open-end fund, as I said, I'm the only one with the keys. It's only redeemable by me. I'm the only one that sells them. I'm the only one that buys them and gives you your money back. I will always give you your money back by law. I can't say, well, I got your money, I'm out here. No, I will always give you your money back. The open end is priced by NAV plus the sales charge. As I was saying, closed end is supply and demand. How much people want it and how many are available. The same way common stock normally is priced. But an open end is fixed. We can calculate the NAV. We add a sales charge, and that's what the public offering price is, the price that is offered to the public. When I talk about the seats or the shares in my warehouse, what I'm talking about is common stock. I know it sounds weird, but common stock is just regular ownership. Open end can only issue common stock. Closed end, in every way that you are likely to see it, is going to be common stock. But you do need to be aware that it theoretically could issue preferred stocks or bonds. How those are different than normal preferred stocks or bonds, I got no idea, and it's not important. If you need to know it, you need to know it in the idea that a closed-end fund can issue preferred stocks and bonds. An open-end fund cannot. A closed-end fund and open-end fund both have voting rights. Both get dividends if declared by the board. But only a closed-end fund is going to have preemptive rights. Because the number of shares of an open-end fund change daily. Depending on how many people are buying or how many people are selling, the number changes daily. I couldn't possibly give preemptive rights there. But this is a fixed offering. I could, theoretically, on this boat, build another level. I could add more rooms. In the real world, I'm just going to build another boat. I'm going to build a different boat. I'm not going to go through and add a new layer to this one. It's easier and probably more flexible and better to just build another one. But I could, theoretically, issue additional shares, in which case the current shareholders, the current seat holders, have to get preemptive rights. Closed-end investment companies, again, can issue common stock, preferred stock bonds. Think of it like a stock, limited number issued, priced by supply and demand, not by the actual value and its commission. And it's like building the boat, selling off sections, shipping it off, and as it rises and falls. But you've got to find someone to buy it or sell it. You can't just, I'm not buying and selling. I'm afraid of the water. I'm not getting back on. No redemptions, and they're only exchange trading. Open-end funds are mutual funds. Issuer must always sell and redeem shares. I, as the fund owner, as the warehouse owner, must always buy and sell. The number of shares outstanding changes daily. There's a board of directors, structured so that at least 40% is unaffiliated from outside the company. Understand that at least 40% is unaffiliated means at most 60% is affiliated. Those affiliated could be directors, owners, even investment advisor. We have the idea of a diversified investment company. Diversified must follow the 75-5-10 rule. 75% of the assets are invested so that no more than 5% of it is in any one security, and the fund owns no more than 10% of the shares of any one issuer. There are no requirements on the other 25%. How does that look in pictures? Well, we have the entire 100% of the fund right up here. If we look at just this 75%, which we're going to look at right down here, no more than 5% can be invested in any one company. So they need at least 20 companies. If you put 5% in A and 5% in B and C and D and E, you're eventually going to put 5% in T and B out of money, and you're going to have 20 letters of the alphabet. You need to put at least in 20. Remember, it's diversified. Don't put all your eggs in one basket. We also can't buy more than 10% of the shares of any one company. We can't buy total control. The idea is to limit how much of control I could have. Because if I go and totally control 20, 30, 40 companies, I have at least 20 companies. I'm not investing, if I'm big enough, I'm not investing more than 5% of my money in any one of them. But I control them. So it's not really diversified. There's not a difference of opinion there. They're just a part of my company. So the idea with this 10% is that I can't control too much of these companies, so they're still independent and diversified. If it's a big investment company, the 10% of that rule is more imposing, more limiting. Smaller investment companies, the 5% is more limiting. Very rarely are both ever going to be needed and considered in the same question, same idea. The regulated investment companies, these are following the pipeline, the conduit theory, the subchapter M. If the investment company passes on at least 90% of the income to its investors, then the investment company itself is not going to be taxed on the income. This is done to avoid the double taxation in mutual funds. Because if money came in, taxes would come out, it would then have to go to the corporation. The corporation would then send the money out, well, taxes would come out. The rest would then go to the investors. But if this happens, if this was, say, 30% taxes in this first one, and the second one was 30% taxes, that means going through this process, the investors are effectively paying 51% in taxes. That's what double taxation does. If they use a regulated investment company, if they're using the Subchapter M rules of the IRC, the Internal Revenue Code, well, then the money is going to go straight to taxes once. The money is then going to go down to the investors as if through a pipeline to the investors. This same Subchapter M rule holds for other investments like REITs. If they pass on at least 90% of their money, they're not double taxed. Understand, if they pass on 90%, that means they're paying tax on 10% of their money. If they pass on 92%, that means they're paying tax on 8% of their money. If they pass on 89.9% of the money, that means they are taxed on 100% of the money. If they do not give at least 90%, all of it is taxed. Forward pricing. NAV must be calculated. The net asset value must be calculated at least once every day. If you had to do something at least once every day, and it's something you really didn't want to have to do, but by law you had to do it at least once every day, how often would you do it? Once a day. NAV is calculated in the real world once every business day at the 4 p.m. Eastern Standard close of the market. Client will receive the next calculated NAV from when their funds post, when they actually get to the fund company. So if the client actually posts at, say, 2 p.m. on a Thursday, the next close is Thursday, 4 p.m. So they're going to get Thursday's close 4 p.m. NAV. However, clients post on, say, Friday at 5 p.m., well, 4 is when it had to. The next NAV, the next calculated NAV is going to be Monday at 4 p.m., the close of business. Redemption of shares are going to work the same way. The 7-day rule is law. As I said, I must do the redemption. I can't not do redemption. If I can't just say, I've got your money, I'm going to leave. I must close, I must repurchase and redeem any of my investment company, my mutual fund shares. If there is an emergency, which really has never occurred, the New York Stock Exchange really doesn't close outside of normal holidays under extreme emergencies. Hurricane Sandy, 9/11. I mean, there have been some times, but you can go and look up how often it happens. It's very rare. So the 7-day rule being law, it usually takes less time than that. Now, mutual fund share classes. There are three basic share classes. What we need to make sure that we know are that there's an extra one as well that's not included. A shares. A shares have an upfront sales charge. They have breakpoints, rights of accumulation, and letters of intent. We're going to be discussing those in the next few slides. They're best for long-term investors. Those are where you come to give me money into my warehouse, and although I'm selling shares at, say, $100, I'm actually making you pay me $105 per share. I'm giving a little less. Or if you give me $100, I'm giving you a little less than one share. I'm taking the upfront charge there. B shares are contingent deferred sales charge. Contingent means maybe, deferred sometime in the future, sales charge. The idea with this is it's got an upfront, when you first get it, they've got a sales charge at the end, a deferred sales charge when you sell it. But each year, that deferred sales charge goes down. After a certain number of years, it eventually hits 0, and then B shares become A shares. C shares, the B shares, by the way, are where when you redeem your warehouse shares with me, is when I keep some of that as my profit. C shares have no upfront or back-end sales charge, but they have the highest annual sales fees. This is where we figure out some membership where you're paying me on a monthly basis kind of thing for me to manage your money instead of upfront or at the end. It's best for short-term investors. No-load shares are different. These are not C shares. These are generally index funds. These have the lowest sales fees, at most 0.25%. Most of what you are going to be selling in the real world are A shares. You occasionally may be selling C shares. You almost certainly are never going to be selling B shares. I don't know when it is appropriate to sell B shares. I really don't. The idea is, yeah, technically, if someone's got a small amount of money that will never benefit from any of these, small amount of money for a long term, B shares might be competitive with A shares. But in my view, when you've got someone who doesn't have enough money that's ever going to reach these, it may be better that they do something else with their money, like an emergency fund or something, because this money, it may not be the best thing for them to invest, kind of thing, if they're never going to be able to benefit from these and they know it. When we get to them, you'll understand that as well. I have sold C shares. I sold C shares in a bond fund to 19-year-olds. 2. I got called on it. Expect to be called into your principal's office if you sell anything other than A shares. They're going to say, justify this. Because when I got called into my principal's office and they said, justify this, and I went, well, these young men are in the Marine Corps. They're going off to Iraq for 6 months or 9 months. They're going to get paid double the normal salary. They have no expenses. And if we don't do something with the money, they're going to come back with more money in their bank account than they know what to do with and go to a bar and have a weekend that they're never going to remember and then wake up broke. So what I want to do is take half of the money, put it in a short-term account where in 2 or 3 years when they're out of the Corps, they'll be able to fix up their car, they'll be able to go to school, get an apartment, things like that, and they won't be able to spend the money. Principal heard that and went, okay, signed it and submitted it. Went through. Just be prepared to justify it. Again, it was weird. His signature was on there. He called in. Makes perfect sense. But C shares are for short-term investors. 2, 3, 4, 5 years is when they want to need it. Maybe worth looking at C shares. More than that, A shares are almost certainly going to be the better idea in the real world. The costs and fees. There's management fees. There's surrender charges. Charges that are realized when the policy or investment is sold or redeemed. It could be decreasing and eventually be eliminated, like B shares, like annuities. It could be constant. It could be zero. Some C shares do have a small surrender charge during that first year, sometimes only the first 6 months. You are not supposed to trade mutual funds. Trade mutual funds like trade stocks, buy and sell for short-term gains. You're not supposed to do that with mutual funds. They're designed as a buy and hold, a long-term strategy. So the idea of trying to day trade mutual funds is bad. That's why they might have a small surrender charge to discourage that kind of activity. There are sales charges. These are charges that are realized when the policy or investment is purchased. They're generally going to be level. They'll usually step, so that the more you invest, the lower the percentage is. Expense ratios in mutual funds are the total fees divided by the total assets. That's all it is. It's going to be the lowest in a no-load fund, then A shares, then B shares, and then C shares. Breakpoints are the dollar amount for the purchase of the fund shares that qualify an investor for a reduced sales charge, for a reduced load. Investment clubs and co-ops are specifically excluded from breakpoints. You cannot just form a group specifically to get breakpoints. We're going to look at an example. Don't bother memorizing this. These are just random that we picked, that we sort of made up just to go through this. But it's less than $25,000. You're going to be paying 5%. If you're paying, say, $250,000, you're paying 2%. So if I put in, say, $10,000, well, I'm clearly paying 5%. 5% of $10,000 is $500. Okay. So I'm going to put in $100,000. Well, $100,000 is right here, so I'm paying 3.5%. 3.5% of $100,000 is $3,500. So it doesn't surprise us that I'm paying $500 for $10,000 and $3,500 for $100,000. Makes sense that I'm paying more in fees. I'm investing more money. But I'm investing 10 times the money at 7 times the fees. The fees are going down in a stepped up manner. Sort of the same idea if you were going to be ordering t-shirts for a club and it was like $18 per custom t-shirt, but if you ordered 10 it was $15 per t-shirt, but if you ordered 100 it's $12 per t-shirt, and if you order 1,000 it's $10 per, like the more you order the cheaper each individual unit becomes. You're spending more money, but it's still individually cheaper. Same idea with breakpoints. Now, breakpoints are for lump sums, single deposits. What if clients don't have the lump sum? Well, there's two options there. We have a letter of intent. Letters of intent where the investor promises to meet a certain breakpoint within 13 months with new money. All contributions are made with the sales charge of that breakpoint. And you can backdate it up to 90 days. Because when I first opened this account last month, I really didn't think that I was going to be able to make any of these over a little over a year. I really didn't think in the next roughly year I'd be able to make $25,000. But I just got a raise today. And now I go, I might. So I'm going to go and do a letter of intent and include that first payment I made 30 days ago to include there, and I can backdate it. But if it's not met in 13 months, extra fees are charged at the normal sales charge. These aren't penalties. I don't mean to imply that these are a fee as in like a penalty. The idea is if there were two people, each put in, say, $10,000. One of them promised within 13 months that they would put in a total of $25,000. The other one didn't. When they first get that statement, the one who signed the letter of intent promising to put $25,000 in is going to look like they have more money because they had lower fees. Come 13 months later, when no other changes occurred, no one's put more money in, it still looks like the one who signed the letter of intent, who made the promise they weren't able to keep, looks like that they have more money. But when the letter of intent expires, the fees are going to be assessed so that they become identical. It's not additional. They're not penalized. It's basically they time travel back in time, charge the appropriate fees back then, and adjust the account value to what it would have been if that was what the fees were. There's no extra fee. There's no penalty. But it does not include appreciation. It's new money only. It uses the same breakpoint schedule. It's going to use the same breakpoint schedule as the breakpoints. But the sale price is going to be on all of the contributions. The other type of when you get these combined breakpoints does not include all contributions, only future. The letter of intent is all contributions. So if I'm going to be giving $2,000 a month, after 13 months I'd have donated or contributed $26,000, which is over the $25,000. So every month that $2,000 would have a 4.25% sales charge, not the 5%. Because I promised. Now, if I missed and I wasn't able to make it, it would just be adjusted as if I'd paid that 5% the whole time. If a client gives $5,000 promising to meet $25,000, 12 months later the account has grown to $15,000. It's been a good year. Tripled in value, good year. How much more does the client need to contribute? This needs to remind us it's new money. The client promised to give $25,000 of new money. They've contributed $5,000. That means they owe $20,000 of new money, or it's going to be adjusted. Letters of intent do not include accumulation. Rights of accumulation is where the accumulation matters. Investors have a right to receive cumulative quantity discounts after over time building up an amount of value in the mutual fund. We're permitted to combine assets from their accounts and accounts of immediate family. That's spouse, children under 21, and financially dependent family members. But appreciation of the shares is considered. It is important. The sale price is on all future contributions. However it took me to get up here, all that was at whatever sale price. Once I hit the right of accumulation, the new breakpoint, future contributions are at that sales charge. So if I'm going to be giving $1,000 a month, well, after 13 months, I'd have given $13,000 of new money. That's less than $25,000. So I can't do a letter of intent. So I'm investing at a 5% break point. $50 a month is coming out. But after 25 months, I'd have given $25,000. Maybe actually after 22 months, it's grown to $25,000. Maybe after 27 months, because the market hasn't been great, whatever. And then when I continue contributing the $1,000, then I'm going to be at 4.25%. I'm going to be saving $7.50 a month more. The important thing about a right of accumulation is if a contribution is going to cross a right of accumulation by a penny, if it hits that break point, the entire contribution gets that break point. If I have $75,000 in the account, that puts me in the $50,000 to $100,000 break point. If I put $50,000 in, that puts me into the next break point. But 25 is sort of in this one, 25 is in the next one. Doesn't matter. The whole 50 gets the best breakpoint, the next breakpoint. If any part of the contribution crosses a breakpoint, the entire contribution gets that breakpoint sales charge. Remember the other day when you paid for a candy bar with a credit card? Dave Ramsey and Susie Orman are here to slap you silly. That brings us to the end of the open and closed end. You're going to see additional resources below. These are important, especially if you're going for the Series 6, as open end is what we're going to be selling as mutual funds. We're going to be getting into annuities on the next slides, which are the next unit, which is also very important. They are very similar in some ways to mutual funds, but quite different in other ways. Hope you enjoyed this, and I'll see you again shortly.